90% of millionaires built their wealth through one specific strategy, and it's not what you think. They didn't win the lottery, inherit money, or create viral TikToks. They did something so simple that most people completely ignore it. And by the end of this video, you'll know exactly what it is and how to start today. Let's be honest about money for a second. Right now, your cash is sitting in a savings account, earning maybe 1% interest while inflation eats away at its purchasing power every single day. That $100 you saved last year, it's worth about $93 today. Your money is literally shrinking while you sleep, and most people have no idea this is happening. But here's where it gets interesting. There's a way to flip this script entirely, and it starts with understanding what investing really means. Investing isn't gambling or playing the stock market like some Wall Street movie. It's simply putting your money into assets that have the potential to grow or generate income over time. Think of it as hiring your money to work for you instead of letting it sit around doing nothing. The magic happens through something called compound growth. Einstein allegedly called it the eighth wonder of the world, and once you see how it works, you'll understand why. When you invest $1,000 and it grows 10%, you don't just have $1,100. Next year, that entire $1,100 grows by 10%, giving you $1,210. The year after, $1,331. Your money starts making money, which then makes more money. Now, before you think investing requires a finance degree or thousands of dollars, let me break down the actual investment types that matter. Stocks represent ownership in companies, and historically, they provided the highest long-term returns. When you buy a share of Apple or Microsoft, you literally own a tiny piece of that business. The catch? Stock prices bounce around like a ping pong ball in the short term, but over decades, they've consistently trended upward. Bonds are essentially loans you give to governments or companies in exchange for regular interest payments. They're steadier than stocks, but offer lower returns. Think of bonds as the reliable friend who always shows up on time, while stocks are the exciting friend who might cancel last minute, but throws the best parties when they do show up. Real estate lets you earn money through rent while potentially gaining value over time. The challenge is that houses cost hundreds of thousands of dollars, and you can't sell half a bedroom when you need cash quickly. This brings us to something called REITs, which lets you invest in real estate through the stock market with just a few $100s. Then there's cryptocurrency, which has captured everyone's attention lately. Bitcoin and other digital currencies can provide massive returns, but can also lose 50% of their value in a matter of weeks. If you decide to invest in crypto, treat it like hot sauce on your financial meal. A small amount can add excitement, but too much will burn your mouth. Here's what nobody tells you about getting started. You don't need thousands of dollars or a fancy financial advisor. Reputable brokers like Fidelity, Vanguard, or Charles Schwab offer fractional shares, meaning you can buy a piece of expensive stocks with just $50. These platforms have made investing more accessible than ordering food through an app. For beginners, I recommend starting with index funds or ETFs. These are like buying a sampler platter instead of betting everything on one dish. An S&P 500 index fund gives you ownership in the 500 largest U.S. companies all at once. Instead of trying to pick the next Amazon, you own a tiny piece of Amazon, Apple, Google, and 497 other companies. Quick clarity, ETF versus mutual fund. Both can track the same index. ETFs trade like a stock all day and usually have slightly lower fees. Mutual funds trade once per day at the closing price. For most beginners, a broad market ETF with a low expense ratio is perfectly fine. If you want ultra simplicity, target date funds automatically adjust from more stocks to more bonds as you get older. A simple starting allocation might look like this: 70% in a broad stock index fund for growth, 20% in bonds for stability, and 10% in something optional like REITs or international stocks. This isn't financial advice, just an example of how diversification works. You're spreading risk across different asset types and thousands of companies. Want a shortcut? Robo-advisors can do this automatically. You answer a few questions about your goals and risk tolerance. They build and rebalance a diversified portfolio of ETFs for a small fee. It's set and forget investing. The amount you start with matters less than consistency. Investing $50 monthly for 30 years will likely outperform investing $5,000 once and never adding to it. This strategy is called dollar cost averaging, and it removes the impossible task of timing the market perfectly. Speaking of timing, let's address the elephant in the room. Short-term trading looks exciting on social media, with people posting screenshots of massive daily gains. What they don't show you are the losses, and statistics show that over 80% of day traders lose money. The people getting rich from day trading are usually selling courses about day trading, not actually trading. Long-term investing requires patience but rewards it handsomely. The stock market has never lost money over any 20-year period in history, despite crashes, recessions, and countless predictions of doom. Time in the market consistently beats timing the market. Risk is unavoidable, but it's manageable through education and diversification. Stocks can drop 20 to 30% in a bad year, and crypto can move even more dramatically. The key is understanding that short-term volatility is the price you pay for long-term growth. Focus on years and decades, not days and weeks. Fees quietly drain wealth. A 1% annual fee sounds small, but over 30 years, it can shave six figures off a six-figure portfolio. Prioritize low expense ratios, think 0.03% to 0.15% on major index ETFs, and avoid unnecessary trading costs. Low cost equals more compounding for you. Rebalancing keeps your risk in check. Once or twice a year, compare your actual mix to your target. If stocks ran hot and you're now 80-20 instead of 70-20-10, trim winners and top up the laggards. It feels counterintuitive, but it locks in gains and controls risk. Choose your risk lane. Conservative, 40% stocks, 50% bonds, 10% cash or short-term bonds. Balanced, 60% stocks, 30% bonds, 10% REITs or international. Growth, 80% stocks, 15% bonds, 5% satellite, REITs, Intia, One Tech Tilt. Pick the lane that lets you sleep at night and stick to it. Before investing a single dollar, build an emergency fund covering 3 to 6 months of expenses. This prevents you from selling investments during market downturns when you need cash for unexpected bills. Also, high-interest debt is negative compounding. Knock that down first. Make taxes your ally. If available to you, tax-advantaged accounts, like retirement plans, let your money grow without immediate taxes on gains and dividends. Max the tax-efficient buckets first, then invest in regular brokerage accounts. In taxable accounts, broad index funds are typically more tax-efficient than constantly trading individual stocks. Stay informed, but avoid information overload. Reuters, Bloomberg, and the Wall Street Journal provide reliable financial news. Investopedia explains complex terms in simple language. For learning investing fundamentals, content creators like Graham Stephan and Andre Jick offer practical advice without excessive hype. How to read a basic chart. Look at the long-term trend, note the 52-week range, and ignore intraday noise. If you can't explain why an asset should grow, earnings, cash flows, rent, or adoption, you don't need it in your portfolio. 7 steps to start today. Build emergency fund. Open a reputable low-fee brokerage account. Turn on automatic transfers on payday. Pick one broad stock index ETF plus one bond ETF or a single target date fund. Set your allocation. Reinvest dividends automatically. Rebalance once or twice a year, then leave it alone. Common beginner traps to avoid. Chasing hot tips, over-concentrating in one stock or coin, panic selling during dips, using leverage without understanding it, and constantly changing strategy. Boring wins. Consistency wins. Costs matter. Remember that 90% of millionaires I mentioned at the beginning? They built wealth through consistent investing and appreciating assets over long periods. They didn't find secret strategies or take massive risks. They simply started early, stayed consistent, and let compound growth work its magic. Your future self is counting on the decisions you make today. Even small amounts invested consistently can grow into substantial wealth over time. The best time to start investing was yesterday, but the second best time is right now. If you want a simple rule to live by, automate your investing, diversify broadly, keep costs low, and be patient. Do that, and the math does the heavy lifting. If you found this video helpful, make sure to hit that like button. It really helps the channel reach more people. And if you want to keep learning how to build real wealth in the digital age, subscribe and turn on the notification bell so you don't miss the next breakdown. We post weekly videos on investing, digital income, and financial freedom, all simplified and made practical for beginners. Drop a comment below and tell us what part of investing you want us to dive deeper into next. Stocks, crypto, real estate, or something else. Thanks for watching.